with the ongoing conflict between Ukraine and Russia, we thought it was an opportune time to relook at our forecast for global growth, inflation and interest rates. So as of today, we're sitting at an oil price of $130 and forecasted the markets are looking at somewhere towards 200. It's obviously going to have a big impact on global growth, and in particular for Europe. In fact, for Europe, we think best case, it's a scenario of stagflation, but increasingly it's looking more like recession. And obviously, that will have a big impact on earnings growth, for Europe. For the US, again, at best, we're probably looking at stagflation at the moment. So all of these factors have still to be played into the markets, going forward. Now, in terms of interest rates, what we're expecting is that the Federal Reserve, Jerome Powell, chairman, has said, I expect 25 basis points. He'd support that. The market is feeling, because of this high inflation and problems around the world, that maybe the central banks will hold back. But I think with stagflation, it's likely that you're going to have to increase rates. 25 bips maybe this time, but certainly 50 bips going forward to tackle the inflation problem. The problem with inflation is not just the oil price, it's also food prices as well. We're seeing wheat and corn prices rising. And that's going to have, at some point, both with the oil prices and food prices rising, will lead to some demand destruction. More and more people will be using their disposable income to pay their energy bills and their food bills, and less money for discretionary spending. So the good news in some respects is that whilst inflation might rise sharply, with demand destruction at some point, the fall in both inflation and commodity prices will just be as sharp as the rise that we've seen. So the fall would be very significant. So that's the good news, but in the short term, there's a lot of pain for the markets to deal with.